Our next guest says there's an abundance of extremes in the markets right now, and he likes that. Joining us now with more is James McDonald, founder and CEO of Hercules Investments. When I read that, James, when it seems like there's extremes, with what we've seen recently when things have been so good and so positive, if you believe that we're at an extreme, I would think that the opportunity would be to fade the extreme or go the opposite way of the extreme. So would you characterize yourself as bearish because we're so overheated? Is that where the opportunity is?
Absolutely. Good morning, Joe. And
really?
I was sad to see the debate. What we like about this market is that we've seen moves in the indices, whether it's the Dow, the S&P, the Russell, that have never happened before in modern times. You have to go back to 1933, 88 years to see a rally like this. And what that tells us is that a normalization is imminent. And a normalization in this market means a correction. We still haven't seen a correction in the S&P 500. We did get that in the NASDAQ. There was a rebound. We did get that in the Russell. Still haven't seen it in the S&P. And to the earlier points, this is not your father or your grandfather's S&P. The big tech companies have been bullying the S&P for a couple of years now. And even then, they're at 52-week highs, persistent 52-week highs. And so we do think there's an imminent pullback here. And to the comments earlier about lumber and a whole host of other commodities, we are overheated to the point where it's unsustainable. And so at this opportunity, our bearish bet that we've been holding for quite some time is about to pay off. We're really excited about seeing this.
It hasn't happened yet, but you think we're getting close.
Well, either that or we're going to see a 45% S&P print for a 1 year, a full calendar year, and that's never happened before. As we head into the next quarter, most of the excitement about earnings and most of the excitement about the reopening was priced in. You know, we saw valuations at all-time records back in January, back in December, and we've exceeded those. You know, we're 24% higher than we were at the peak prior to the pandemic without the fundamentals to back it up. We also know that fundamentals matter less in this market because of the concentration of success in those tech companies, as well as the overall effusiveness that we've seen across the board, whether it be in crypto, whether it be in commodities, whether it be in stocks, or whether it be in, let's call it speculative investments. And so it isn't as much as it's going to come down crashing, but we do need to see a pause, and a normalization, a mean reversion would mean a huge upside for us.
That's the question, James. With something like an Amazon or pick a company that's fared very well during the pandemic and then compare that to a Beeple NFT. Is there definitely a correlation there? Is it related, or can some of these big winners actually, is it justified by the fundamentals that they're trading at these levels while other things are representative of the fluff? Or does the fluff in one area always translate or mean that some other areas are also vulnerable as well?
Well, what we see is a divergence, right? And so some things are justified. If you have a company like Apple Computer, a company like Google, a company like Microsoft that's making money hand over fist and is expanding and growing and increasing margins, of course you're going to see valuations there. But if you have a company like Zoom or a company like Netflix that has run ahead of its earnings and run ahead of its success, there has to be a pause and a pullback there. Even Tesla, we had so many conversations about Tesla's valuation being absolutely incredible, and their success and their growth justified that somewhat. Now here Tesla is negative year to date because all of that was priced into the run-up. I think the divergence is going to be companies that are established in generating huge profits versus companies that had huge potential and saw that potential realized in their price valuations as the run-up.
Shepard Smith here. Thanks for watching CNBC on YouTube.